Let's start off today P1. Remember we have already done few areas of costing. So what are the areas we have done costing? We have done costing on areas, absorption costing we have done it, isn't it?
Yes.
We have done the absorption costing. What is absorption costing? Where the overheads are absorbed according to machine hours, labor hours, or products, or number of units, Then we have the marginal cost. We are on the marginal costing where the overheads are not absorbed. Overheads are not absorbed. Overheads are charged to that particular period. So you don't charge the overheads according to the machine hours, no labor hours, no number of units, anything. Whatever the overheads, you charge it to that particular period. Then we did the activity-based costing. Activity-based costing where the overheads are charged, overheads are absorbed according to the cost drivers, cost activities. And we apportion the overhead, or we absorb the overheads according to the cost drivers. Then last week we learned something called joint product costing.
Yes.
Joint product costing. That is where you have one common process, and through the process you have more than one product coming up, and then how you apportion that cost between these main products. So these were the things what we have learned right up to this point. So on the absorption costing, your inventory will be valued at total cost. At marginal cost, your inventory will be valued at marginal cost. At activity based, your inventory will be valued at total cost. And joint product costing, we saw it will be valued again on total cost, but the costing will be different, and we will be apportioning the overheads according to three methods we learned: physical measurement, or the market value at the point of split.
Yes.
At the point of split, or the net realizable value after processing. Right? So these were the couple of things we have learned it right up to this point. So we are going to move forward from this one today into a new kind of a costing, what we call throughput costing. So we did the example, we did everything. We are moving into a new area of accounting called throughput costing. So let's talk about the throughput costing. So you can see, as the name says, it is not throughput costing, it is throughput accounting. So it's another method of costing, but we don't call it costing, we call it more of throughput accounting. So you remember the marginal cost. Marginal cost, we came across something called contribution, that was the sales minus the variable cost. And the variable cost was considered direct material, direct labor, and variable overheads. All these are considered variable cost. So and sales minus variable cost, we get something called contribution. And from the contribution, right, the contribution should be good enough to look after your fixed overheads and also your profit.
Yes.
So the profit is equivalent to contribution minus fixed overhead. So
yes,
that is what we saw it in the marginal costing. But here we see a slightly different version. Here we don't call a contribution, we call it throughput, TP, throughput. Here the throughput is sales minus material cost. That is the only difference. Sales minus material cost, only the direct material. So here the direct labor, variable overheads, all are considered as fixed expenditure. And this is, in a way, this is true, because today most of the labor is not variable, because whether you work or not, whether you produce or not, you have to pay a minimum wage. And therefore, labor is no longer a kind of a variable cost. So because of that, what we do is, we try to work it out. Give me a second, Sam.
Okay, no problem.
Hello. Yes. හරිෂෝ කෝ නියමයි හොඳයි. ඔව්. මොකද තැන. අපි හවසාම මේ පාට විතර වගෙනකොට ආව කොහමද? ඔව් පාන 6 විතර වුණා එනකොට ඔව්. චාමර ගියා. ඔව්. ගිහලා ඊයේ දවල් ඊයේ early ආවේ යාගේ යාළුවෝ වගේ බෙන්තට එනවා කියලා early ආවා. ඔව්. ඊයේ early ආවේ යාවා බෙන්තට මේ මොකද්ද මේ එයාගේ යාළුවෝ වගේ එනවා කියලා මේ ආවා. ඇවිල්ලිවල ඊට පස්සේ එයා වෙන මාමා මේ ෂපිත් එක්ක ආවා. ඔව්. නාමර ගියා මාළුත් ඇල්ලුවා ගිහලා ගිහිල්ලා. මොකටද? ඉතින්? ඔව්. Hello.
Hello, yes.
Yeah, right. Yeah, sorry. So we were talking about the throughput. So you can say the throughput. The difference is here in the marginal costing we take the sales minus variable cost. Variable costs include direct material, direct labor, and variable overhead. But here only the material cost is taken. So in other words,
Yes.
the throughput should cover fixed overheads. It should cover profit, and also it should cover direct labor and variable overheads also, right? Which is not covered up in the contribution should be covered up in the throughput. So this is a new method of doing, because the belief is that whenever you are producing something, it is the material cost that you are handling, and every other thing is internal. So the only thing what you purchase from external is the material. So they work on the material, and through the material they say it is being worked out. So it is the material that is being converted, and that's why we call it the throughput. And they believe the sales is the final outcome. So if you don't do any sales, no throughput. So you must sell it. So once you sell it, what you get is the throughput, and from the throughput you should be covering up fixed overheads and profit, which is already in the marginal costing, plus the direct labor and the variable overhead. So surely you will understand throughput should be larger than the contribution. Throughput should be larger than the contribution. Throughput should cover up 4 areas, whereas the contribution should cover up only 2 areas. Clear?
Yes.
Yeah. So this is what the new style of thing. This is totally a new concept which was introduced maybe about 10 years back, but it is very, very important. So let's look at this one. So throughput accounting is similar to marginal costing. It can be used to make long-term decisions about capacity, production equipment. So it can be used for long-term capacity equipment.
Okay.
Yeah. So it is something which can be looked at from a long-term point of view. Also to look at the capacity and production is based on 3 concepts. Now this is what we need to know: the throughput, inventory, and operating expenses. So throughput is what we said just now. Throughput is sales minus material cost. Sales minus material cost. So that is what we call the throughput. From the throughput, we must remove the operating expenses to arrive at our profit. So operating expenses include direct labor. Operating expenses includes overheads. Overheads means both the overheads. Fixed overheads and variable overhead. Fixed overheads and variable overhead. So, and also that is what the operating expenses is. And also they believe inventory is a waste cost. They don't believe in keeping inventory. So any inventory is going to add cost to your production, and that is a waste, and that is going to reduce your throughput. So the throughput account is based on three concepts: the throughput, inventory, and operating expenses. So if you take a particular material, let's assume that you take a particular material, clothing, right? Maybe you have done the clothing, you have cut it, you have done the cutting, you have done the you have done the stitching, you have packed it, all that is done for the material, but not yet sold.
Yes.
Not yet sold. So according to the throughput accounting, none of these things are considered as valuable item. Cutting, stitching, all that, because you look only the sales minus the material cost is your throughput. So all that cutting, stitching, everything done is not worth unless you finish the product and unless you sell the product. And therefore, inventory in the throughput method is valued only on the material cost basis. Material cost. So all the other value additions like the cutting, stitching, pasting, all that is zero cost. Zero value. No work. So it does not recognize any work that you have done unless you have done a product and sold it. So to that extent, the inventory is valued on material cost only. So that makes a very, very important thing for us in the three methods of costing, how the inventory is valued. In the absorption costing, inventory is valued at total cost. In the marginal costing, inventory is valued at marginal cost. Marginal cost is the direct materials, direct labor, and variable overheads. But in the throughput costing, on the throughput accounting, inventory is valued at material cost only.
Okay.
So these are the three different kinds of inventory valuation because the throughput does not recognize any other cost. So only the total cost in the absorption total costing, in the marginal costing, marginal cost, that is direct material, direct labor, and variable overheads. In the throughput costing, only the material cost. So these are the three methods. So you have to be very careful because in short questions you might have a question about the inventory valuation method of the three methods. Activity based, total cost.
Okay.
Activity based also, total cost. So these are the three methods that we need to know all the time. All the time, yes. So the basic principle in the TPA on the throughput accounting is that the manager should aim to increase throughput while simultaneously reducing inventory and operational expenses. So remember, the throughput is sales minus material cost. So you must increase the throughput. So to increase the throughput, either you must increase the sales or you must reduce the material cost. You must increase the sales or by reducing the material cost, you can increase the throughput. And from the throughput, to arrive at your profit, you must minimize your operational expenses. So the little operational expenses, you will have a bigger profit. And also the inventory. Inventory, right? The inventory cost is a cost which is going to reduce your profit. So throughput minus operating expenses minus inventory cost is your profit. So if you can minimize this one, if you can minimize this one, and if you can maximize the throughput, your profit will be high. So, and the throughput costing, you must maximize the throughput, minimize the operating expenses, and minimize the inventory. Because inventory is not going to add any value for you. Inventory is considered only as the material cost. So you might have done all the things, but still no value for it. So because of that, if on the throughput accounting, if you want to increase the profit, minimize the operating expenses, minimize the inventory cost, maximize the throughput. So this is where in the throughput accounting your focus will be. So throughput. So in throughput, the only cost that is related to the volume is the direct material cost. Is the direct material cost. You only consider the direct material cost as something worthwhile, something which is material, something which is relevant. Others are not considered having anything to do with your value addition. So you can spend your labor, you can spend your operating expenses, but it is not going to add any value, or it is not going to add the throughput. So only cost that is going to consider is the direct material cost. All other costs, including labor, is deemed to be fixed, because the labor is considered fixed because most of the time the labor is fixed. So then these fixed costs may be called total factory cost. So all the fixed costs, that is direct labor, variable overheads and fixed overheads, are called total factory cost.
Right. You can give me just 1 minute?
Okay, sure.
Thank you very much.
Okay, right. So we were talking about under throughput, when you call total factory cost, it is the direct labor, variable overheads, and factory overheads. That is what we call total factory cost. But if you remember in the absorption costing, when you call factory cost, it is the again direct labor, direct material, and also the factory fixed overheads and the variable overhead. But on the marginal costing, when you call factory cost, it is the factory overheads only.
Yes.
So different accounting systems have different terminologies being used. Right. So throughput contribution is the revenue minus total. Throughput contribution is revenue minus total variable cost. Total variable cost is only the material cost. Only the material cost. So aim of the throughput contribution, yes. So this is actually not really the total variable cost. It should be only the total material cost. The aim of the TP is to maximize this measure of throughput contribution. So how to maximize? Either you must increase the revenue or reduce the material cost. So you must be very efficient in your procurement. You must be very efficient in your selling. Throughput, revenue minus direct material cost. Right? That is what the throughput is. So we have something called conversion cost. Conversion cost. So what they say, the material is the thing that is being converted into a finished product. You take a material, you take a piece of garment, and you do the cutting, stitching, pasting, and doing all that, and you convert it into a short or a shirt or a sack or whatever it may be. So that is what we call the conversion cost. So the material, whatever that material, you will put your direct labor, you will put your overheads and convert it into a finished product. So this is your direct material. To that one you add labor, you put overhead, and you convert it into a finished product. So this process is called the conversion cost. Conversion cost. So the direct labor, factory rent, depreciation, all are considered as conversion cost. You take the direct material and you do whatever you have to do it, and that is a conversion cost. So if you are in a hotel, the direct material will be your vegetables and the fish and everything, and you cook it and you use the the cooks and the chefs and the gas and the whatever, the curry powder and everything, and you convert that one into a finished good, and that is considered a conversion cost. Right. So basically what we look at is we look at the material and we do a conversion and we arrive at a fixed product. Okay. So let's look at what it is mean. Investment. Now in the throughput, the investment means the everything that you intend to invest on buying things you intend to sell. Right? So this is defined as the money the business invests to buy things it intends to sell. So your raw materials, right? And your money that is invested on the finished goods. All that is what you intend to sell. And all the money tied up in assets so that the business can make the throughput. So to make the throughput, you have to convert it into things. So the property, plant, equipment, all that is your investment. So the raw material, finished goods, everything is considered investment. So the investment includes unused raw materials, unused. If it is sold, no problem. But anything that is not sold is investment. Anything that is partly processed is investment. Anything finished goods not yet sold is investment. So all that you have put up on the money is what we call the investment. Right? And also it will include the non-current assets, right? That is the non-current asset that you use to create materials or to buy material. And equipment and building, R&D, all will be classified investment. So if you look at under throughput, the investments will be raw material, work in progress, unsold finished goods, and also your property, plant and equipment, and also your R&D. All this is your investment. So you need all these investments, and of course every organization try to minimize the investment. So you must try and minimize your raw material investment, try and minimize your work in progress, try and minimize your unsold finished goods, try and minimize your property, plant and equipment, try and minimize your R&D. Of course, you have to be careful. Don't minimize it to that level that where you will not have any new products, new research and development happening. Okay. So then we discuss something called operating expenses. So the operating expenses are basically it is another term for conversion cost, the money the business spends to produce the TP. That is the turn the inventory into TP. So it is not to correct think operating expenses as fixed costs, not really fixed costs. They are costs that are not totally variable, right?
Variable.
Yeah, not totally variable. Only variable, totally variable cost is material cost. Only totally variable cost is direct material cost. There are certain other costs which are not fully fixed, not fully variable. So they both, the partial variability, partial fixed, all that is called operating expense. So operating expenses include direct labor, variable overheads, fixed overheads, everything. Only thing under throughput that is considered totally variable is the direct material cost. So this is totally a new concept of accounting. So let's look at the profit reporting in your TP setup. Right? So let's look at the TP setup. So profit how the profits are going to be looked at. So I'm going to put this slide and for you to understand it. So let's look at the profit reported in TP. So revenue. So revenue is your total revenue. That is what you have sold. You have sold 750,000. Raw material. That is the totally variable cost. That is only variable cost in the TP, 200,000. And you arrive at what we call 550,000. So that is revenue minus material cost is what we call the throughput, and that is 550,000. And from there, you deduct all operating expenses. That is direct labor, variable overheads, fixed overheads, all that is what we call operating, even selling expenses. Even selling. All that is deducted and you arrive at your net profit. So you can see compared to the marginal costing, where the marginal costing you look at the 750 and you look at probably the marginal cost, which is direct material, direct labor and variable overheads, maybe about 300,000 or 350,000, and you arrive at 400,000. This is what we call contribution in the marginal costing, and from their margin contribution we will deduct the fixed overheads, fixed expenses, which could be 250, and you will arrive at 150. So you can see, what you can see is whether it is throughput or marginal costing, your total expenses are 600,000. Right? Total expenses are 600,000. But the difference is how you show it. In the TP, you show only the raw material after the revenue. But in the marginal costing, you show raw materials, direct labor, and variable overhead. But altogether, it is still 600,000. So your profits are not varying. Profits will be the same, but unless there is a change in the inventory, because inventory valuation is different. So because of that, there can be change. So there is something called super variable costing. So let me put up this one. Yeah. So I want to put it up in this one. Yeah. Yeah. So super variable cost. So let's look at what is super variable costing. So TP is described as a form of super variable costing. It is considered as a super variable costing. The TP is considered similar to MC, thus it is considered as an alternative to MC. So the marginal costing and 2P goes together, but not really true. In TP, you don't have the concept of product cost. You remember in the TP, we have the sales, we have the material cost, we get the throughput, and from the throughput, we deduct the operating expenses, and we arrive at something called the profit. But in the other two areas, in the absorption costing and the marginal costing, we have the sales minus marginal costing, we get the contribution, and from the contribution we deduct the total production fixed overheads. Then we get your profit. Profit. So there you can see we can value the inventory on the basis of what we call a product cost. But here we don't have a product cost. No attempt to charge operating expenses to product. So no operating expenses are ever charged to the product. So unlike in the earlier methods, we don't have that one. So this makes the TP different from total absorption costing, marginal costing, and ABC. The difference is we don't allocate a portion, the operating expenses to the products. Yeah. So that's the difference. So, yeah. So inventory valuation. So in TP, inventory should be valued at only the purchasing cost of raw material. Any parts you have bought from outside, right? So if you have bought anything, only that is your inventory. Nothing else is your inventory. Hello? Hello?
Yes.
Yeah. Okay.
Yes, I'm listening here.
Right, okay. Right. So in the TP inventory, as I said, only cost is the raw material and any parts that you have purchased from outside. Nothing else is considered in the inventory valuation. It should not include any other cost, including labor. So this is totally different from your total absorption costing and marginal costing inventory valuation. No value is added by the production until the item is sold. So you can produce many items and keep it useless because it is not going to bring you any profit, anything, because the product is not considered valuable unless it is sold. Yeah.
Yes.
So that is what it is. So let's look at some example. So company makes 1,000 units of an item and sells 800 during a particular period for 8,000. Cost of production are 3,000, direct labor 2,000, fixed production overhead 1,000, other overheads 1,000. So they make 1,000 units and sell 800 during a particular period. And how much are they selling? 8,000. So at 10 per unit, at 10 per unit they are selling 800 and they are making a revenue of 8,000. And the material cost is 3,000, direct labor 2,000, fixed overhead 2,000, other overheads are 1,000. Right. So now I'm going to use this example to show you the profit under three accounting methods: under absorption, marginal costing, and throughput accounting. Okay? Right? Absorption costing, marginal costing, and throughput accounting. Okay? Hello?
Yes, I'm listening. Yes.
Okay, right.
Yes.
Okay, right. So I'm going to use this example to show you the profit. And so the aim of the assumption is that, so let me see whether we have got the figures. No. Oh no. Right. So we're going to work that one. We're going to work that one, first of all, before we move in. Right. So the company makes 1,000 units of an item, sells 800 during particular. Cost of production are material 3,000, 2,000, and 1,000. So let's first of all,
Yes.
let's first of all look at under throughput accounting. Throughput accounting, sales 8,000, sales 8,000. Your direct material cost are, you have made 3,000. 3,000. So your throughput is 5,000.
Yes.
Throughput is 5,000. Then
Yes.
all the others are considered, these are called operating expenses. Operating expenses are direct labor 2,000 and fixed production overhead 1,000 and other overhead 1,000.
1,000.
Yeah, 4,000 gone. So you have 1,000. 1,000.
Yes.
So 1,000 is there, but of course you did not sell all the units. You sold only 800 units. So there's 200 units inventory. So the closing inventory is 200 units. 200 units will be valued only at the direct material cost. Direct material cost per unit is $3 because for 1,000, right? 1,000 units they have spent 3,000. 3,000 for 1,000 units. So the direct material cost is 3. So 3 into 200 you will add it up. That is the only thing you can add it up, the closing stock, and your profit will be 1,600. So on the throughput, your profit is 1,600. Clear?
Yes.
So now let's look at under marginal costing. And the marginal costing, what is going to be your profit? So this is your throughput costing. So let's look at the marginal costing profit now. So marginal costing, the sales will be 8,000 still. Right?
Yes.
Sales will be 8,000. So cost of production are 3,000, direct labor 2,000, and other overheads. Let's assume the other overheads are variable. So let's assume these other overheads are variable. So your marginal cost is 2,000 plus the 3,000 plus the 1,000, right?
6,000.
6,000. So you will deduct that one, you arrive at something called contribution.
Just 2,000.
2,000 is your contribution. And then you deduct
Yes.
your fixed overhead 1,000.
It's 1,000.
Still you have the 1,000. But only thing, now your inventory valuation is different because your inventory value will be valued at marginal cost. Marginal cost is 6,000 for 1,000 units. So the marginal cost per unit is 6. So 6 into 200, 1,200. So you will have a profit of 2,200. Can you see? Yeah?
Yes.
So the throughput profit is 1,600, but marginal cost profit is 2,200. The reason the throughput does not recognize any of these other labor and everything what you have added up. Right? So now let's look at the same thing with the total production cost, absorption costing. Let's assume that absorption costing is also used. So let's look at the total production thing on the absorption costing. So the sales are 8,000 still. Sales are 8,000. Your direct material, and now you don't take only the direct material, you take the direct material, direct labor, so we can take everything together. Right? So 3,000, 2,000, 1,000 and 1,000. Deduct everything. Deduct everything. So you will have still 1,000. So you can see under all three methods that 1,000 remains 1,000. But the profit changes because of your inventory. Now here the inventory will be valued at total cost, including material, direct labor, fixed overheads and other overheads, 7,000. Right? 7,000 divided by 1,000 is 7. 7 into 200, 1,400. So your profit will be 2,400.
400.
Can you see? There are three different methods bringing you three different profits. And what is the difference? Where is the difference coming up? Where is the difference coming up? Difference is coming up on the valuation of inventory. Isn't it?
Inventory.
Right
Yes.
up to that point, the 1,000 is the same 1,000. Right? It doesn't change.
Yes.
But valuation of inventory makes difference in the three methods. The throughput brings a very low profit. The marginal cost brings a fairly bigger profit. But the absorption costing brings a very high profit. Because the valuation of inventory. Because in the valuation, in the throughput, you don't consider all the costs. Right? In the throughput, you don't value any other things. You value only the material cost. In the marginal cost, you value the material and the labor and the variable labor. In the absorption costing, you value all these things together. So that makes a big difference. That makes a big difference in your calculations. Yeah?
Yes.
Right. So that is very, very important that we realize that one and we understand this principle. This is the biggest thing that you need to understand between the three concepts. Okay. So,
Okay.
right. So, maximizing the TP. The aim of the TP is to maximize the TP on the assumption that operating expenses are fixed amount in each period. So, operating expenses, as I said, direct labor, direct materials, all that is considered as fixed. Right? If the business has more capacity than there's a customer demand, it should produce to meet the demand in full. So, the market demand is 1,000. And if you have a capacity to meet the 1,000 units, you must produce it. Because every time when you produce and sell, you go and add to the TP. You increase your TP. But on the other hand, right, on the other hand, if there's a constraint is that you can't produce to the full level. You can't meet the full demand level because you may be having a constraint. So that constraint, it can be material, it can be labor, it can be anything else. So that constraint must be used to the maximum to get the best TP. Yeah. So that is what it means. So you don't if you don't have a problem, you must go and produce the maximum. You must go and produce the maximum. But on the other hand, if you have a constraint, you must look at that constraint, and that constraint must be maximum. So that means we have to look at what is the product that is going to give you the highest TP. Highest TP, and that is achieved by what factors prevents TP being higher. So this constraint, we call it a bottleneck. What is a bottleneck? Bottleneck is something which is preventing me from meeting the demand, the total demand. That is what we call a bottleneck. So it can be the direct labor, it can be the machine hours, it can be it can be the material, whatever that is going to block me from meeting the demand is what we call a bottleneck. But if you, on the other hand, if the demand is 1000 and if you have capacity for 1500, don't produce 1500 because you are not going to add any TP. TP is added only by the sale. So stop it at 1000. Don't produce anything more than 1000 because it is not going to bring you any benefit under TP accounting. TP will only consider your sales. So don't produce anything more than your capacity. Clear? Hello? Hello? Hello?
Yes.
Yeah.
Yes.
So,
Yes.
yeah. So
Hello.
what I told was, if your capacity is 1500 and the demand is 1000, don't produce 1500. Because that extra 500 you produce is not going to add any TP. TP is always based on the sales minus material cost. So don't produce any extra production.
Yes.
But if the demand is 1000 and if you have capacity for 1000, go and produce. But if the demand is 1000 and if the capacity is 800, look at what is going to block you. And that is what we call the bottleneck, and that bottleneck we must try and maximize. So we are going to look at how to maximize the bottleneck. So bottleneck. So if this is not possible, ensure that they are fully utilized. So bottleneck may be a machine whose capacity limit. So it may be the machine time. So first thing, you must identify the bottleneck and remove them. So always try and see what is the bottleneck and try to remove them. So that is your task. So as a manager, as a management, you must try and identify your bottleneck. And once you identify the bottleneck, try to remove it. Okay? Hello? Hello, 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 hello. Hello?
Hello. Yes.
Yeah,
Yes.
yeah.
Hello.
So I was just telling you the management should try to identify the bottleneck. It may be one bottleneck, it may be two bottlenecks, but you must identify. Yeah. What is a bottleneck? What is going to prevent you from meeting your demand? Something that is going to prevent you from meeting your demand. So if this not is possible, ensure that they are fully utilized at all times. Remove the bottleneck. So identify and remove them. How to remove it? You should be able to increase your machine hours. You might be able to increase your labor if that is a bottleneck. So just try and remove it. But if sometimes you can't remove it, you may not have enough machine capacity. In that case, we must use that bottleneck to the maximum capacity. Non-bottleneck resources should be scheduled and operated based on the constraint within the system. So if your demand is 1000, right, you may have direct materials to meet the 1000, you may have direct labor to meet the 1000, but your machine hours may be only for 800. So in that case, don't take 1000 direct materials, don't take 1000 direct labor, only because your machine hours are 800, you schedule your production to use 800 direct material, 800 direct labor. Because useless doing anything more than that, because you can't go beyond that one, you are restricted by 800. So always, your decision should be hanging around the bottleneck. Any non-bottleneck should be used to produce more. Non-bottleneck should not be used to produce more than the bottleneck can absorb. So don't try to plan it for 1000 production when your bottleneck is machine hours and it is going to stop you at 800. So this is why throughput accounting is a very, very important one. It is going to help you to to do a lot of decision making rather than wasting your resources. So you will not unnecessarily hire direct labor. You will not unnecessarily buy direct material. You will not unnecessarily advertise, because you know you can only produce 800. So one way is to identify the bottleneck and remove it. How to remove it? Yeah. How to remove it? How to remove it? Right now, you know the machine hours are only 800 you have, so that's a bottleneck. So the way to remove is to see whether we can hire a new machine, and add 200 hours. Then no problem. Add 200 hours and use the machine to the full capacity. But if you can't do this one, stop production at 800. If you can increase the machine hours to 200, do it. If you can't do it, stop production at 200. So we are going to look at an example now. So particularly when you are producing more than one product. So first of all, identify the bottleneck. What is the bottleneck? Then calculate the total TP contribution per each unit of product. Calculate the TP per unit bottleneck resource. Rank the product. Step 5, allocate resources used in this ranking and do the production. So let me give you an example how to do this one. So TP accounting measures, let's talk about it in a moment, but I want to go and allocate the resources and give you an example. So yeah, these ratios, let it be for a moment. I don't want to go that one, but I want to look at a particular example and work it out. So let me work out an example for you. So let's assume that you have a product. Give me a minute. I'm going to take an example and work it out with you.
All right.
Yeah. So let's look at a good example here, right? So let's assume there are two products. One is a product called X. Yeah. One is a product called X, and the other one is a product called Y. And let's assume the selling price, product X is 15, product Y is 20. Let's assume direct material, product X 10, product Y 11. And let's assume the maximum demand for product X is 25,000 and product Y is 30,000. Right? So let's assume the labor hours required is the bottleneck. Hello?
Yes.
Yeah. Let's assume the labor hour required is the bottleneck, and to produce the product X you need 2 labor hours and product Y you need 6 labor hours. Right? So the total labor hours available is 80,000, and that is your bottleneck. So let's assume that is the bottleneck. So let's assume total factory cost is 128,000. So these are the details that is given. So let's assume, let's work out the maximum product mix and the maximum profit that we can get it up. Right? So let's work it out on this one. So here what we will see is the product is going through 2 processes, right? So they have given us all these examples. So let's work out on the basis how much we should be producing, right? So we know the selling price is 15, direct material is 10. So we know 15 minus 10, 5 is the throughput.
Yes.
5 is the throughput. For the Y, it is 20 minus 11, 9 is the throughput. Right? Now we know that the lab hours or the bottleneck is the lab hour. So X is going to take 2 lab hour. So we want to find out throughput per lab hour. Throughput per lab hour. So 5 divided by 2. So 2.5. Here it is going to be 9, but divided by 6, it is going to be 1.5. So what it says is, right, the labor is our problem, but if I produce X with 1 labor, I can get a $2.5 throughput, and with Y, I can get only 1.5 throughput. So my best production or my best resource utilization should be for X, and then it should be Y. So this is what we call ranking. We rank the product. So based on your throughput, right, 2.5 per unit and 1.5 per unit. Remember the throughput is 2 per unit and throughput is 5 per unit and 9 per unit. If there were no constraint, you should be producing Y. Right? But because the labor is a constraint, you must produce the best utilization of labor. So labor, when you produce 1 unit of X, it gives you a 2.5, and Y, it gives you 1.5. So now I want to see, okay, 25,000 is my excess demand. So how many labor hours do I require? How many labor hours do I require to produce the 25? Because that is my maximum demand. So 2 into 25, 50,000 labor hours. Correct?
Yes.
2 into 25. So how many labor hours balance available? What is the balance available labor hours? Total 80.
Yes, 30.
30 is available. So with the 30, I can produce Y. Right? Now to produce Y, I need 6 labor hours. So 6 into 30 is 180. I don't have. I can only produce 30,000 divided by 6. I can produce only 5,000.
Yes.
Right? So I can produce, so here 25,000 I can produce, no problem. But here with the 30,000 I have, I can produce 30,000 divided by 6, only 5,000.
Only 5,000.
Now that is what the throughput is going to tell you. So throughput is going to tell you, produce 25,000 of X. So when you produce 25,000 of X, you get 5 into 25,000 throughput. So X throughput is 5 into 25,000, which is 125,000. And Y, when you produce 5,000, it is 6 into 5,000, 30,000. So altogether, it is 150, 30,000 balance, 6,000, yeah, bottleneck. So I can produce 5,000. So when I produce 5,000, 5,000, yeah, 5,000, I get 9 into 5,000, 20 minus 11, 9 into 5,000. So I get 45,000 throughput. So altogether I get a throughput of 170. My total expenses are 128 operating expenses, which leaves me with a 42,000 profit. So that is what the throughput is going to tell you. So whenever we have a limitation on the bottleneck, what we must try and do is we must try and maximize that bottleneck. So I want you to go to this example. I will send you this recording. I want you to go to this example very carefully and manage it. Okay?
Sure.
Yeah.
Right.
You must carefully go through, because I don't want to do the throughput ratios till you understand this area. So I want you to take carefully this area and go to this one carefully, and you will come across the whole thing. So go through this example, with particularly the last example which I have worked it out, and tell me how you are going to feel about it. Okay?
Okay.
So,
Yes.
yeah. So we have to have another session one of these days. How is your program tomorrow, day after?
Yes. Tomorrow is okay.
So tomorrow
And after
can,
tomorrow.
pardon?
Tomorrow and after tomorrow is
Tomorrow,
okay with me.
yeah. So tomorrow can we meet at same time, 9 o'clock your time, Dubai time?
Yes.
Hmm?
Sure.
Yeah,
Yes.
yeah. So let's meet and finish up the throughput tomorrow. So go to this area, and tomorrow let's make it at 9 o'clock again.
All right.
Okay, right. So we will then we can finish up the throughput and go into the break even. So let's finish up the throughput tomorrow. Okay. So I'll see you tomorrow at 9 o'clock. Hello.
Hello.
Hello. Yeah. Tomorrow I'll see you at 9 o'clock tomorrow.
All right. All right.
Yeah. Right. Okay. Thank you. Thank you. Bye.
Take
Bye.
care. Thank you,
Bye.
Mama.
Bye.
Yes,
Bye.
bye.